What I'm about to outline should give policymakers serious pause. This week, the data revealed something remarkable and deeply uncomfortable about the state of the global economy and America's position within it. The United States stock market has just recorded one of its weakest performances relative to the rest of the world in more than a decade. And while much of the attention remains fixed on Wall Street's headlines, other countries have been quietly outperforming it by a wide margin. Canada, in particular, stands out. Now, let's deal in facts because the figures tell a story that has received far too little scrutiny. In 2025, the S&P 500 rose by 16%. On the surface, that sounds impressive. Record highs, strong headlines, celebratory commentary. Yet when placed in global context, the picture changes dramatically. Canada's stock market rose by 29%. Mexico posted gains of 25%. South Korea surged by an extraordinary 80%. In a ranking of more than 60 major stock markets worldwide, the United States placed 41st. 41st. For the world's largest economy, that is not a position of strength. More revealing still is the performance of the MSCI All-Country World Index, excluding the United States, effectively a measure of global markets without America. That index rose by 29%, nearly double the U.S. return. This marks only the third time in the past decade that American equities have fallen so far behind international peers. And crucially, this is not simply a bad year. It is a signal of something more structural, a shift in where growth, confidence, and capital are increasingly being directed. Yet listen to the political rhetoric in Washington, and you would struggle to detect any concern. Senior figures continue to present stock market milestones, including talk of the Dow approaching 50,000 as proof that economic policy is working. But markets do not exist in isolation. When viewed globally, the United States is being outpaced by economies across Europe, Asia, and the Americas. And then there is the currency. In 2025, the US dollar fell by 9.4%, its worst annual performance since 2017. For the world's reserve currency, long regarded as the ultimate safe haven, this decline is significant. Officials now concede that international confidence in the dollar is weakening. And that matters because currencies are not merely instruments of exchange, they are reflections of trust. What the data increasingly suggests is that countries around the world are making strategic choices, and the United States is no longer the default option. To understand why, we need to revisit policy decisions made at the start of 2025. The administration introduced sweeping tariffs on imports from across the globe. The stated objectives were familiar: reduce the trade deficit, bring manufacturing back to American soil, and force trading partners into more favorable agreements. The theory was that economic pressure would yield leverage. In practice, the outcome was very different. The figures speak plainly. The U.S. trade deficit in 2025 stood at $91.5 billion. In 2024, it was $93.5 billion. After a year of tariffs, trade disputes, and economic brinkmanship, the deficit barely moved, a reduction of roughly 2%. In real terms, the strategy failed to achieve its central aim. Worse still, the underlying dynamics of global trade shifted in ways that should concern American policymakers. The trade deficit with China did fall from $296 billion to $202 billion, and at first glance, that appeared to validate the approach. But the trade did not disappear. It was redirected. Vietnam's trade surplus with the United States surged to $178 billion. Taiwan's more than doubled to $147 billion. Thailand, Malaysia, and other Asian economies recorded sharp increases as supply chains were rerouted. This is the critical point. Manufacturing did not return to the United States. Companies simply moved production elsewhere. Goods continued to enter the American market, consumers continued to bear higher costs, and supply chains became longer, more complex, and less efficient. The tariffs reshaped trade routes, but not in America's favor. And while this was unfolding, something notable happened north of the border. Canada recorded a trade surplus for the first time since the trade war began. As the United States continued to run deficits, Canadian exports exceeded imports. exports to non-U.S. markets rose by 17.2% in 2025. The proportion of Canadian exports destined for the United States fell from 76% to 72% in a single year. That may appear marginal. In trade terms, it is anything but. It marks the beginning of a strategic reorientation, one that reflects a broader global trend now taking shape. That shift may sound modest, but in the language of global trade, it is profound. Canada's export data confirms that diversification is no longer theoretical. It is delivering measurable results. Exports to non-U.S. markets reached an all-time high by December 2025, and this expansion is not confined to energy or raw materials. Manufactured goods, technology, and services are all playing a growing role. Canada is not retreating from globalization. It is repositioning itself within it. Europe is doing much the same, and on a far larger scale. The European Union has embarked on what it describes as the Rearm Europe program, an $800 billion initiative aimed at rebuilding the continent's defense manufacturing capacity. Converted, that amounts to roughly $928 billion. The significance lies not only in the size of the investment, but in its design. American firms are, in practice, largely excluded. Alongside this sits the Security Action for Europe Fund, $150 billion earmarked specifically for defense projects. Its rules explicitly bar U.S. defense contractors from accessing the capital. European officials have been unusually candid about the motivation, reducing reliance on American military hardware. This is not symbolic, it is structural. The consequences are already visible. Germany has announced plans to raise defense spending to 3.5% of GDP. Poland is spending 4.7%, the highest level in NATO. Across the continent, the additional funding is flowing overwhelmingly to European manufacturers. Defense spending in Europe reached $381 billion in 2025, up from $218 billion just 4 years earlier. Budgets have nearly doubled, and American firms are finding themselves systematically edged out. What sharpened this trend further was NATO's adoption of a new target: defense spending equivalent to 5% of GDP by 2035. That translates into trillions of dollars over the next decade, and Europe has been clear about where it wants that money to go: into domestic industrial capacity, not overseas suppliers. Markets, as ever, are responding faster than politicians. European stock exchanges delivered some of the strongest performances globally in 2025. Greece, Poland, the Czech Republic, and Spain led international rankings. Germany's DAX reached new record highs. The UK's FTSE 100 posted its strongest year since 2009, rising 21% and crossing the 10,000-point mark for the first time. At the same time, Asia surged on the back of artificial intelligence and semiconductor demand. Taiwan's chip industry saw exceptional growth, while South Korea benefited from a global memory chip boom, pushing its market up by 80%. These were not speculative surges. They were driven by tangible industrial demand. The contrast with the United States is instructive. American technology stocks dominated headlines, but international markets quietly delivered superior returns. Investors who allocated capital globally rather than concentrating on the S&P 500 nearly doubled their gains in 2025. That is not ideological, it is arithmetic. Then came a further rupture. European governments began moving away from U.S. technology services, citing security concerns. France, Germany, and other major economies started shifting government systems toward domestic or open-source alternatives. Publicly, the justification was cybersecurity. Privately, officials pointed to reliability. European leaders are now openly questioning whether the United States remains a dependable, long-term partner. Statements that would once have seemed unthinkable are now voiced without hesitation. Europe must be capable of defending itself without American support, not because it wishes to, but because it can no longer assume that support will always be there. This strategic recalibration feeds directly back into trade. What Europe is doing mirrors developments elsewhere. Countries are diversifying relationships, reducing dependence on U.S. markets, and building resilience against political risk. These decisions are not reactive. They are deliberate, long-term, and increasingly irreversible. And the implications of that shift are only beginning to be felt. The evidence of this diversification is now unmistakable. Trade flows show a clear and accelerating move away from dependence on the United States. Europe's trade with non-US partners is expanding rapidly. China recorded a global trade surplus of $1.2 trillion in 2025, a record, even as its trade with the United States declined. Mexico, meanwhile, is increasing trade with partners outside the U.S. at its fastest pace in decades. What distinguishes this moment from earlier shifts in global trade is its cause. This is not the result of a weak American economy. It is the outcome of policy choices. When governments weaponize tariffs, threaten allies, and treat long-standing partners as adversaries, the response is not outrage. It is adaptation. Countries act strategically. They diversify supply chains, sign new agreements, and reduce exposure to risk. Once those alternatives are built, they do not simply vanish when policy changes. Supply chains are not light switches. Relationships formed under pressure tend to endure. That is why what we are witnessing is structural rather than cyclical. It represents the most significant reconfiguration of global trade since China's accession to the World Trade Organization. The numbers illustrate this starkly. In 2025, the United States recorded a $219 billion trade deficit with the European Union, with Vietnam $178 billion, with Taiwan $147 billion. The stated objective of tariffs was to reduce deficits and force reciprocal trade. The result was the opposite. Companies did not reshore production, they rerouted it. Consumers paid higher prices. The deficit remained largely unchanged. But the deeper impact lies beyond trade balances. The defining feature of U.S. economic policy in 2025 was unpredictability. Tariffs were announced with little warning. Agreements were threatened, revised, and threatened again. Allies were treated as leverage points rather than partners. International commitments were abandoned. Markets tolerate many things, but they do not tolerate uncertainty. And when uncertainty rises, capital moves. Investment flows towards stability. Companies diversify geographically. Governments hedge their exposure. Foreign direct investment into the United States did not collapse, but its character changed. Manufacturing investment shifted toward Mexico. High-tech capital flowed increasingly to Taiwan and South Korea. European firms that once relied heavily on American suppliers began searching for alternatives. The conclusion is uncomfortable but unavoidable. The United States is losing its status as the world's most predictable business environment, not because it lacks innovation or capacity, but because its policy framework is increasingly seen as volatile. Business surveys now show companies explicitly factoring political risk into U.S. investment decisions, a calculation that would have been virtually unthinkable a decade ago. That shift is particularly consequential in the defense sector. For decades, American firms dominated global arms markets. If countries wanted cutting-edge military technology, they bought from the United States. That assumption no longer holds. European defense companies are now securing contracts that would once have gone to American suppliers. A major German manufacturer has announced plans to open 16 new factories, producing artillery shells at a scale that will soon exceed total U.S. output. Across the continent, governments are investing in domestic weapons systems, fighter aircraft, long-range missile programs, and satellite reconnaissance networks, all designed to reduce reliance on American technology. The long-term implications are severe. Once Europe achieves self-sufficiency, it does not simply stop there. It becomes a competitor. American defense firms will not only lose European contracts, they will face new rivals in global markets. And this pattern is repeating across other strategic industries. Semiconductor manufacturing is increasingly dominated by Asian firms. European pharmaceutical companies are expanding faster than their American counterparts. Green energy technology is now led primarily by Chinese and European producers. These are not isolated developments. They are interconnected signals of a broader shift in industrial leadership. When trade data, investment flows, currency movements, and market performance are viewed together, they point to a single conclusion. The world is hedging against the United States. For three-quarters of a century, the United States has served as the anchor of the global economic system. The dollar functioned as the world's reserve currency. American markets offered depth, liquidity, and stability. U.S. firms set global standards in finance, technology, defense, and trade. That position is not vanishing overnight, but it is eroding slowly and measurably. Central banks around the world are beginning to adjust. Quietly, without dramatic announcements, they are diversifying their reserves. Fewer dollars, more euros, greater exposure to other currencies. The shift is incremental, but the direction is unmistakable. And the stakes are high because the dollar's dominance is not merely symbolic. Oil is priced in dollars. International trade is settled in dollars. Global reserves are held in dollars. This gives the United States immense leverage, from the reach of its banking system to the global impact of Federal Reserve decisions and the power of financial sanctions. That leverage rests on trust. Trust in American institutions, trust in policy stability, trust that agreements will be honored. What the data now suggests is not collapse, but erosion. Confidence is fraying at the edges. This brings us back to Canada and why its stock market performance matters far beyond one calendar year. Investors comparing the United States and Canada are making a judgment about the future. Capital flows reflect belief. When markets favor Canada, they are expressing confidence in predictability, stability, and long-term growth. At the same time, they are expressing unease about American policy direction. This is not about sentiment. It is about expectations. Investment decisions are forward-looking by nature, and the latest figures show that international fund managers are increasing exposure to Europe, Asia, and emerging markets while trimming positions in the United States. That reversal would have been extraordinary just a few years ago. Today, it is becoming routine. What makes this moment particularly troubling is the durability of these changes. Economic relationships, once disrupted, are difficult to rebuild. Supply chains that have been diversified do not snap back simply because political rhetoric softens. Trust, once lost, takes years to restore. Consider the practical implications. Canadian firms that spent 2025 building commercial ties in Asia are unlikely to abandon them quickly. European defense manufacturers investing billions in new capacity will not reverse course even if transatlantic relations improve. Mexican factories that replace Chinese production will not close simply because tariffs are reduced. These are long-term strategic decisions, not temporary adjustments. The evidence already points to permanence. Infrastructure investments reflect a world preparing for reduced reliance on the United States. China is constructing ports, rail corridors, and shipping routes that bypass American-controlled choke points. Europe is developing payment systems that function independently of U.S. banks. New trade agreements are being signed that explicitly exclude American participation. The United States is not being forced out of the global economy. It is being routed around. None of this was inevitable. The United States could have preserved its position as the world's most trusted economic partner. The dollar could have remained unchallenged. American firms could have retained their dominance for decades. What changed was not economic capacity, but perceived reliability. In a globalized system, perception matters as much as reality. Businesses relocate when policy becomes unpredictable. Governments build alternatives when they fear coercion. Investors seek stability when volatility becomes political rather than economic. The data shows this process is now well underway and accelerating. There are signs that American officials are beginning to recognize the problem. Private discussions about restoring confidence are taking place. Proposals for greater policy stability are circulating. Efforts to repair strained alliances are being explored, but publicly, uncertainty persists. And in the absence of clarity, other countries prepare for the worst. Canada, by contrast, has adapted rather than protested. It has diversified its trade, strengthened global partnerships, and invested in sectors aligned with future growth. The results are visible. Record non-U.S. exports, a return to trade surplus, strong equity performance, and rising foreign investment. These outcomes are not accidental. They are the consequence of consistent, predictable economic policy. The same pattern is emerging across Europe, Asia, and much of the developing world. Stability attracts capital. Chaos repels it. None of this implies American decline is inevitable. The U.S. economy remains vast, innovative, and resilient. Its financial markets are still among the deepest in the world, but dominance is not guaranteed. Advantage must be maintained. The real question is not whether the United States will remain a major economic power. It will. The question is whether it will remain the central pillar of the global system or one influential player among many in an increasingly multipolar world. Based on the evidence now available, the latter outcome appears increasingly likely, and that shift will redefine how trade operates, how currencies are valued, how capital flows, and how geopolitical influence is exercised. This is why Canada's performance matters. It is not an anomaly, it is a signal, and the signal is clear. The global economy is diversifying away from the United States.